What's up guys, and welcome to another video. Today we're going to be discussing 4 tips I wish I knew before I started investing. So these are things I've learned pretty early on going through my journey, and these are things I definitely wish I knew before I got into investing. Hope you learned something. If you like the video, please leave a like, comment down below, and please consider subscribing. Let's go on with the video. Right guys, tip number 1 is make sure you use your Icer. So an Icer is an individual saving account, which if you live in the UK is allotted £20,000 per year by the government, which is tax-free. So you can set up an investment Icer, which you can use to negate some of the capital gains tax on the shares that you sell. So, for example, if you bought £500 worth of shares, you can then, let's say they go up to £1,000, so you've made a capital gain of £500. If you didn't have that in an Icer account, you would pay capital gains tax on the additional £500, so that could be 10% or 20% depending on your tax bracket. However, if that money is in your tax-free Icer account and within your limit, you don't have to pay capital gains tax when you sell those shares. So it's one thing to consider is potentially look into an Icer account. However, what it doesn't do is it's not entirely tax-free. You still pay dividends tax on the dividends you collect annually, but I mean, it's a great thing to not pay capital gains tax within the bracket if you're going to sell shares in that time period. So that's tip number 1. So guys, tip number 2 is FOMO, and basically not succumbing to FOMO. So FOMO being fear of missing out. And I guess when you start investing, it's, you know, get a little giddy, get a little bit excited, you know, you might be on the trigger finger, kind of thinking, oh, that stock looks really good, it's, you know, it's had really good years, it's you know, it's going up, it's continually going up. I guess, you know, take a breather, do the research, look at other stocks, you know, take some time to get just adjusted to being in that environment. Because I remember when I started, you know, first day I had the account, I almost went and bought a share. And it's that kind of, you know, take a step back, get used to being in the position where you can buy these shares and just kind of get used to the market over, you know, maybe a week or so. Don't just rush in. Don't think, oh, you know, this is the lowest it could go, you know, I don't want to miss out, I might as well buy lots of shares now in this company. You know, take your time, get used to it, get used to the feeling of buying shares, you know, it is risking your own money, don't think it's a game, you know. What's the saying for when the fun stops? I can't remember the gambling thing, but you know it. But I mean, just, you know, don't think FOMO, don't think you're missing out. If the stocks are going low, and on a downtrend, don't think, oh, I must buy them now, you know, they could go even lower, you know, the next day. So if we take, you know, Facebook, for example, recently, they have had loads of companies like Coca-Cola boycotting their Facebook ads, and what that's done is it's sunk the share price last week, and now it's all the way back up. But I mean, there was essentially FOMO of missing out on that downtrend, when I think on the second day of that downtrend they went down even lower, and it's just, you know, getting used to that kind of cycle. That's tip number 2, don't succumb to FOMO. Right guys, tip number 3 is going with a strategy, going with a plan. And what I mean by this is going with a vision or an end goal of what you want to do with your finance in the stock market. Do you want to be a trader, or do you want to be an investor? Of 2 slightly different approaches. So a trader trades basically the peaks and troughs of the stock market. So they obviously buy low and then sell high, but it's over a very short time frame. They are looking at the horizons of, you know, a week to maybe a month, of where they are looking at where that stock could be in a month and buying the volume then when it's low and selling when it's in that kind of high period at the end of the month. Whereas investor is very much super long term, and they're not so much concerned about the changes in the market in the short-term period, but looking, 5-10 years down the line. And I think that for me was trying to figure out what I wanted to be. Was I going in there kind of thinking, Wolf of Wall Street, making loads of trades every day, or was it more like a farmer where you're more about like growing your investments over time, taking a more slower approach, but in terms of just the snowball effect of building up that portfolio of dividends to reinvest and kind of grow that nest, they call it. But I mean, like, figure out your strategy, figure out what you want to do, and make a plan. Don't just get into stocks without having an end goal plan. So mine is kind of not early retirement, but at least going towards my retirement fund. But yeah, going with the plan. Tip number 3. So guys, tip number 4 is getting jacked into the news.
Combat training. Jiu-jitsu. I'm going to learn jiu-jitsu. Holy shit. Yeah, Mikey, I think he likes it. How about some more? Hell yes.
Be jacked into the news. And what do I mean by this? I mean, the value of a stock is essentially based off the social perception of future growth that company can make. And what I mean by that is it is future looking, and everybody says don't look at the past performance of a stock to determine the value of today, and they're right. And what that means is you should be continually thinking ahead. Is the current position the business is in and where it could potentially go in the future still good? So kind of you've got to be like Neo from the Matrix, be jacked in and getting all that information. So what I tend to do is any stock I'm looking up, I quickly type into my search bar at the start of the day and just hit the news tab on that company. And what I tend to do is look at my portfolio, and I do almost a really quick sweep over my portfolio. It's not massive, it's not hundreds of stocks, so when it gets bigger I'll have to come up with a new strategy. But just looking at the news each day around the companies you have in your portfolio, you can suck up information of like current things that are happening, and all it takes is one bit of bad news for the stock price to fall. So for example, again, the Facebook boycotting. So as soon as that was out, the share price tanked. But did the fundamentals of the business change? Did it? Well, it probably might do. But was it based off poor performance of the company in terms of revenue? No, it was based off just bad news. And I think if you get into this game, you are going to do a lot more reading of just general news. And I think for me, that's been one of the benefits of getting into stocks and shares, is actually I have been reading the news so much more than I used to, and it was actually finding it interesting now. So I think that's definitely a really good tip. Right guys, that's today's video done. I hope you found one of these tips helpful in your investment journey. The next thing I need to invest in is probably a haircut with this absolutely terrible lid, but we'll go and sort that out soon. I hope you guys have an amazing day. If you did enjoy this video, please give it a like and comment down below. Let me know what your thoughts were. Please share your investment tips themselves. I think I'd like to obviously learn from you guys, the community. So drop them down there and I'll try and get to them. But yeah, have a great day.